All right, so let's begin. Alternative investment funds or AIFs, which cater to high net worth individuals or HNIs, saw a 30% increase in investment commitments during FY23. At the end of March 2023, the total investment commitments raised stood at rupees 8.33 trillion, which is a jump of almost 1.92 trillion. So what's driving AIFs and what are the factors that are playing here and what does it mean for investors going ahead? Let's understand all of this with Akhil Chaturvedi, Chief Business Officer, MOAMC. Akhil, good evening and welcome to the show. So first, let's understand, what do you mean by commitments for AIFs that have gone up? What does it mean?
So, thank you, Kavita. Pleasure talking to you. So, commitment essentially means the total capital which is committed by the investors for a particular product. For example, in case of alternate investment funds, minimum commitment is 1 crore of rupees. So, that's the commitment amount. However, this is a product generally where the managers call for the product over a period of time. So, there is a drawdown duration. So you may commit a capital of crore with initial down payment of let's say 30%, and then the rest 70% is called as there are investment opportunities which are available. So capital commitment is basically the total amount you're committing for your investment, and then there is a drawdown period over a length of duration. You will comply with fulfilling the entire commitment amount.
All right, let's get some numbers over here, Akhil. The largest contributor to this growth is apparently Category 2 AIFs. That is almost 6.93 trillion worth of investment commitments, okay? So it stood at 2.66 trillion by the end of last financial year. So that's a jump over there. What is this Category 1 and Category 2 and Category 3? Could you just explain this to our viewers?
Yeah, so let me explain the entire concept in totality. So alternate investment funds as a category was initiated by the regulator somewhere in 2012. And the idea behind launching this particular category was to create a variety of boutique products, specialized products for high net worth investors through a regulated way of investing in a regulated environment. So that's where traditionally we had mutual funds, we had portfolio management services, and then alternate investment funds as a concept was launched in 2012. Now, typically AIFs are split into three parts. So there is a category 1, there is a category 2, there is a category 3. Category 1 is basically for funds which are essentially invested into early stage investing, venture capital, startup capital. So those are the kind of funds which are part of the category 1 umbrella. Then we have category 2, like you rightly mentioned, it is the largest category where you have private equity funds, you have real estate, and you have private credit. So both the unlisted space as well as the debt space is housed under the category 2. And then we have category 3, which is basically long only equity investing, as well as long short kind of products. So that's how different products are categorized into different cat 1, cat 2, cat 3. And surely that last couple of years we have seen the category 2 which has grown at a faster pace than category 1 and category 3. This is happened because in the last few years, more specifically in the last 5 to 6 years, there has been a phenomenal rise in the expectations or aspirations of the high net worth individual investors, large clients, family offices, institutions who are prepared to take incremental risk by contributing to the private equity space. On the debt front, there are a variety of funds which offer you higher yields. And that's a space also where we are seeing a lot of capital flows which are moving. So rise in number of HNIs in the country with higher risk appetite and desire to invest some portion of their net worth into specialized products like private equity, unlisted, or the private credit space. And therefore, you're seeing a lot of growth in the category 2. Having said so, we are seeing reasonable growth also in category 3. And Of late, we are also seeing a lot of interest in the category 1 space. So, all round AIF as a vehicle from almost zero in 2012 is almost now, like you said, 9 trillion, so 9 lakh crores, and growing at a very fast pace. So, this is a space which uh, uh, seems like will grow exponentially over the next few decades.
So exactly, the question is the last line that you just said. That in the near future, this particular space is going to grow more. So I want to understand how much of the HNI portfolio is AIF part of in terms of exposure, and also because we are talking about non-traditional way of investment. This is non-equity and not debt instruments, which are also catching up, and HNIs have the attention. It's you can one may also call it a true diversification in its true sense, maybe. But if you're saying that this space is going to grow in the near future, what exactly are we going seeing, in this bigger picture?
Yeah, so let's stick to the category 2 part first. Now, over the last several decades, essentially investors are putting a lot of money through either direct markets, equity markets, or a lot of capital was going into the mutual funds. And in mutual funds, you will have right from a retail investor to largest investors in the institution space. So that was the only platform which was available for one to really participate, whether it was the retail investors or the rich investors. Now, as the AIF as a platform got launched in a structured way, asset managers could create very unique, very distinct product to basically invest into equities of, let's say, unlisted companies, or in the private equity space, which is essentially the growth capital, companies which are away from really getting into the public markets. So investors get an opportunity to diversify their portfolio, while a large part of the capital is already invested in the listed space. But these kind of products are offering investors an opportunity to invest in the private space as well. So when you come into private equity companies, basically you're investing early stage. The real value unlocking happens when once the IPO comes in. So from there till the IPO is where that incremental returns one can actually benefit from, and that is a space where we have seen that HNIs and super HNIs and family offices are putting. I would not be able to comment on the exact percentage, but my guess would be that 20 to 30% of their net worth is actually getting invested into AIFs, and through AIFs into private equity, private fixed income, which have the potential to give higher returns over a longer period of time, as compared to some of the traditional vehicles. So that is essentially the reason of this growth, and we expect this to continue in the future as well.
Two questions now, Akhil. First, the boost that the AIF industry got after the changes in the tax structure for debt instruments, and then the things happening at the regulatory turf. Could you just explain the impact of both of these on the entire AIF structure and working and the sector?
So the taxation change has come into force very recently, more specifically in the debt space, right? So from capital gains, now the taxation for debt investors is basically at full tax rate. Now, if you look at the traditional debt products offering you, let's say 7-8% kind of a gross yield at full tax, the product itself becomes less lucrative. Uh, Now, if you want to remain in the fixed income space, you do not want to get into equities, then you have to take and to generate. And if you want to generate higher gross yield as compared to traditional investing opportunities, then you need to take incremental risk and basically look out for funds who are lending money to corporates, which are offering higher yields. And adjusted for taxation at the current rate, you can still meet your expectation in terms of post-tax yields. So, AIFs tend to, offer you that opportunity to invest into, maybe one grade, two grade lower papers, earning higher yields, and therefore still meeting your post-tax yield, kind of return objective over a period of time. That also means that it comes with a little bit of additional risk, and but I think the rich guys are ready to take that kind of a risk for the additional return.
Traditionally, what's the post-tax return that we are expecting on all the categories of AIF?
Um, so again, in this category, you have several kinds of products, right? So you have plain vanilla fixed income products, which is basically lending into the corporates essentially. Then you have real estate funds, which also are an alternate to kind of a debt kind of product category. Incrementally, we are also seeing a variety of other asset classes like logistics, etc. These are all funds which are created where it is an opportunity to invest in a debt-like product with higher returns. Right now, typically, I would say a rough calculation. If you put typically these funds should give you let's say on an average blended anywhere between 15 to 18% kind of a gross return. I think post-tax, post-expense, 10 to 12% is the band, which most of the AIFs in the category 2 on the fixed income side are likely to deliver over a period of time.
Akhil, is it possible for you to elaborate on the benchmarking for all the categories of AIF that's been decided lately?
So again, for different categories, there are different benchmarks. But I would say that more than benchmark, AIF as a category is more designed from an absolute return perspective, right? So each and every fund is trying to create a portfolio with an absolute return in mind, whether it is 15, whether it is 17, 18, whatever that may be. So there may be a variety of benchmark, but I would urge investors to look at what kind of absolute return strategy the manager is trying to design. Accordingly, the underlying investments would be bought into the portfolio, and then you can work your reverse taxation and those kind of things to arrive at the post-tax number. So there would be different benchmarks for different products, but please treat this as a more like an absolute return product. Like I said, 15 to 17% gross yield kind of a return range.
All right, I think that will be all. Thank you so much, Akhil, for being on the show and helping our viewers with everything related to AIF today. Thank you.
Thank you, Kavita. Thank you so much.